Good afternoon, everyone. My name is Jill Norcross. We're going to continue to let people in, but just a little housekeeping while we wait. We're really excited to have you join us today to learn about CDFIs and grateful for our expert speakers who have been working in this space for quite some time. We decided this time to make it more of a conversation and facilitated discussion. So after some brief presentations and backgrounds, we'll have more of a Q&A conversation. And on behalf of Hannah, Matuda, and our whole Navaja team, we want to just take a minute to thank you all, our audience, because your questions and feedback and suggestions for topics really do truly inform our Lunch and Learn series and our sessions. So please keep communicating with us about your education needs and interests. And we really do hope that that leads to advocacy on your part to help support our housing programs. As you know, Hannah collects all of your suggestions through our RSVP site. And of course, when we're out talking to each of you, when we are in the community, seeing you at events, so it really does impact what we're sharing. So we have learned this year more than ever that topics on both affordable housing finance, as well as potential cuts to federal programs to support affordable housing production and preservation, are at the top of your mind, all of our minds. So we really wanted to highlight a program that we felt like does not always get our attention or understanding, especially in Northern Virginia, and that's our Community Development Financial Institution, or CDFI programs. We're going to hear everything from definitions about what a CDFI is, as well as potential impacts that the federal government has on cuts or protection of this program. It's changing day by day. So glad you are joining us here today. And we're really fortunate to have three CDFIs who work here locally, regionally, and two of them from across the country. We have Shellen Frazier from National Housing Trust, Sharon Bowlers from Enterprise, and Laura Dupree from VCDC here. So we're going to go ahead and get started. Again, feel free to please put your questions for any of our speakers in the chat. We'll go back through and read them. We also have time for more of a facilitated conversation. We do hope to make this very interactive as usual. So we are really grateful to have our speakers here. So first, I'm going to turn it over to Shellen Frazier. She is the Senior Director of Lending and Investments at NHT. That's the National Housing Trust. I really want to thank Shellen. The idea for this session really came out of a conversation that she and I had at an event recently. Like, we need to understand more of what CDFIs do here in Northern Virginia, and maybe why there isn't how to increase lending activity, because it is such an important source. So welcome, Shellen. Thank you for being here with us today.
Thank you, Jill, and thanks to your team for putting this together. I was very amazed at how quickly Jill was able to gather this. And for everyone on the call, I am Shellen Fraser, as Jill mentioned, at NHT, and I oversee our deployment and our capital raising. I've been in the CDFI industry for about 14 years now, worked for a couple of different CDFIs and the CDFI fund, which is kind of like the overseeing likely body of the CDFI industry. For those who might not know, CDFIs are community development financial institutions. We have a shared goal of expanding economic opportunity in low-income communities. So that's really what grounds and guides our work. And we do so by providing access to financial products and services. So the financial part is very important per the CDFI fund. CDFIs look like banks, credit unions, loan funds, and more recently, venture capitalist type providers. And we have done affordable housing, so we will finance homes. We, as CDFIs, do small business lending, and we'll also provide funding for health centers, schools, community centers, really any type of real estate, mainly in businesses that has a goal of expanding economic opportunity. At NHT, some of you might be confused because NHT does quite a few things. We are a policy shop, we are a developer, and yes, we are a CDFI lender, and we provide mainly pre-development, acquisition, and other types of bridge lending for both rental and home ownership projects. We do this nationally, but we really like to think of the DMV, DC, Maryland, and Virginia as home. So we are a full service CDFI within those markets, and nationally we are a but for a lender. So we come in and in the but for space nationally in projects that other CDFIs might not be doing, or in markets and places where there's limited access. Within the Northern Virginia market, we do offer our pre-development and bridge products. And on the home ownership side, we have a partnership with Amazon, and I know this name comes up a lot in Northern Virginia. So we have our Amazon Homeownership Initiative pilot, and it's a $40 million program that Amazon created. So some of you may know on the rental side, Amazon has their housing equity fund, and they've done about $2 billion in three markets. So I think through that work, folks were asking, so what about home ownership? What about home ownership? And they finally decided to partner with NHT, as we have been providing loans to mainly to community land trusts who purchase, rehab, and sell homes at affordable rates that are usually affordable in perpetuity. So Amazon approached us, and we are now working with them on this initiative. 20 million-ish of so were grant dollars that were passed through to organizations, including Housing Alexandria and their project in Northern Virginia. So in addition to their projects in Northern Virginia, DC, we're also working with them in Puget Sound and Nashville, Tennessee. 20 million grant, 20 million a revolving loan fund that's being provided at below market rate for projects that will be affordable into perpetuity. And that will be homeownership projects. As I mentioned, we've done some work with Housing Alexandria. I think we expected to do a lot more in Northern Virginia, but kind of what sparked the conversation with Jill and I is just around, right, who needs our capital, what are the financing needs. As CDFIs, we're oftentimes the most flexible source of capital when you're putting a project together. We come in super early at the pre-development phase, so we take on a lot of the risk, and then we are willing to work with you. For us at NHT, we are not a permanent lender, so it's really bridge short-term funding. That's like 1 to 5 years is typically our sweet spot, but we'll stick there with you until you get through to construction and can get a permanent loan. So I really cannot wait to hear the questions others may have around like what is missing. From my conversations in the market, having worked with APA, not on a Northern Virginia project, but on other projects, it seems like Northern Virginia is expensive. Big surprise there. And your projects are large and your need is greater than sometimes we can provide. I'm sure Sharon will get into what they do at Enterprise, but CDFIs oftentimes like to partner. So we are not super competitive in the way in which we work. And because our mission is what's most important, we're happy to partner to put projects together. So for pre-developmental lending, if your needs are greater and larger than is typical, we work with partners to pull loans together. I've done quite a few of that in DC and throughout the country. Um, so I kind of will just kick it over to, I think Sharon is next to talk through what they do, and I'm happy to take questions and kind of continue on any part of the conversation.
That's great. Thank you so much, Ellen. We appreciate it. We're so glad you're here, and we're going to want to learn more about, specifics of the home ownership program, I think, especially because in Northern Virginia, that just seems to kind of stump our best efforts again around cost. So look forward to talking more about how that actually works and your partnership with Housing Alexandria. So very excited now to introduce Sharon Bowlers, who's here from Enterprise. She's also had a long history, as Enterprise has as well, in this space, full service nonprofit partner. So we're so grateful for you to be here to join us and help us talk through some of what you're seeing in the space as the Director of Lending at the Enterprise Community Loan Fund, which is the CDFI arm of Enterprise Community Partners. So welcome, Sharon. Thank you.
Yes, thank you, Jill, and thank you, Shalon. As Shalon mentioned, we are another CDFI, so I'll talk a little bit about Enterprise and share a little bit about some of our products and offering. As Jill mentioned, Sharon Ballers, I'm a Director of Lending with Enterprise Community Loan Fund, and again, we are the CDFI within the Enterprise Community Partners. And for those who may not be familiar with Enterprise Community Partners, we're a national nonprofit that exists to make a good home possible for the millions of families without one. And so to do this, we're organized around three central goals. The first is increasing housing supply. Second, to advance racial equity. And third, to build resilience and upward mobility. So now to achieve these goals, we operate across three divisions. We have our solutions, our capital, and our community development, and some similar to NHT. Our solutions division focuses on programmatic, and we have a prolific policy team as well as our advisory services. We have our capital division, which comprises our housing credit, our equity, and our conventional mortgage products, as well as the CDFI, which is where I sit. And we also have our community development division, which is one of the largest nonprofit owners and developers of affordable homes in the region. And so Enterprise Community Loan Fund, we are one of the largest nonprofit loan funds in the country. As Shalana mentioned, there can be for-profit and nonprofit CDFIs, but we are a nonprofit. For 2024, we did over 200 million invested, and our track record to date is we have over 3.1 billion invested throughout the country. And similar again to what Shalon mentioned as a CDFI, we're generally the early stage capital in projects. So we provide the pre-development financing, acquisition bridge financing, as well as other bridge products. And again, as an enterprise affiliate, we remain committed to providing affordable housing solutions throughout the entire region. We are national, but Enterprise has several impact markets, and the Mid-Atlantic is one of our largest and more active impact markets. So that, of course, includes the Northern Virginia market. And our goal really is to work across our platform to support this. And again, I'll back up a little and just talk a little bit about Enterprise and our capital solution, because we really run the gamut in terms of providing capital products to support low-income affordable housing projects, as well as just supporting economic development and low-income communities. As I mentioned, the CDFI, we provide our pre-development acquisition and bridge financing and some construction financing. We are one of the largest syndicators of the low-income housing tax credit. Again, that's a national platform. We also have our conventional equity team that provides conventional equity into mostly preservation of affordable housing projects. And then we also have our CDE that provides allocation to new market tax credit projects. And of course, last but not least, we have our Bellwether Enterprise, which provides permanent financing, largely through agency financing. So that's Fannie, Freddie, HUD products and so forth. And so while our goal is as much as possible to partner within the organization to support the development of affordable housing projects, we are in no way tied to any other part of the organization. And so we work with other organizations, other lenders, other investors, and so forth in order to provide financing. And so again, I'm sure it's lost to no one here how challenging it has been in recent times, really, to provide capital into the market. And given the continuing challenges, we continue to be focused on finding low-cost, flexible capital to support affordable housing projects. Some of these include capital magnet funds, So that is the CDFI. They actually provide these fundings competitively. They're competitively awarded grants to CDFIs and other qualified nonprofit housing organizations. These awards can be used to finance affordable housing project activities as well as related economic development activities and community service facilities. Awardees of these funds are able to utilize the funds to create come up with creative financing tools such as loan loss reserves, revolving loan funds, risk sharing loans, and loan guarantees. For enterprise, for ECLF, we largely use this capital to allow for us to provide more competitive rates and also be more flexible in terms of where we sit within the capital stack, and sometimes going higher LTV, or sometimes if we can do MASDAT or so forth. Another source that we've been able to, our program we've been able to leverage is the Federal Home Loan Bank Affordable Housing Program. So this is a funding source that can provide grants to affordable housing projects. And ECLF is a member of the Federal Home Loan Bank of Atlanta. Applications have closed, but we seek to provide, or to say, sponsor applications for affordable housing projects, which help to fill gaps. And so one of the questions I get a lot, I think folks are way more interested now than I think they have been before, is really how our CDFI is actually capitalized in order to provide funding. Again, just giving a lot of the noise that's happening at the national level. So a lot of it comes, and again, there goes in variations depending if you're for-profit, nonprofit. Just very briefly, for-profits can actually issue stock or so forth to capitalize themselves. We're a nonprofit. So we can get funding through the CDFI fund, various awards such as financial assistance, HFFI, I mentioned, capital magnet fund, bond guarantee fund. Could have federal, state, local governments providing funding. Again, the Federal Home Loan Bank. Enterprise, we are rated, S&P rated, so we can actually go out into the capital markets to raise our capital. And there are a number of other CDFIs that are also rated and have the capacity to do so. There are a large portion comes from a lot of CRA motivated banks, insurance companies, foundations, and we also have an investor note program that allows for more funding to come in. And again, each CDFI is capitalized in a varied way. For us, again, we are fairly lucky. Our funding sources are pretty diversified. The largest source really is CRA motivated insurance companies, as well as our impact note. For us, really less than, I think it's like 3% of our capital actually comes from the federal government. So that makes us less at risk when it comes to much that's happening now. And so I'll just take a moment again to just share some feedback from, or some information from our federal policy team as they've been tracking what's been happening at the federal level as it comes to CDFIs for those who may find it interesting. So last month, a president issued his budget, the skinny budget, and that budget request actually sought to provide $133 million for the CDFI fund. This would actually be a $291 million, or a 59% decrease from the FY25 enacted budget. The budget, however, does propose $100 million of new funding for a rural financial assistance program that would support investment and seek to spur economic development in rural communities. This would actually require that 60% of the CDFI's loans and investments actually be funded in rural areas. And again, if folks are not familiar, most CDFIs already lend pretty substantially in rural areas. And if you're a national CDFI, there are a number of programs that are already focused on rural areas. But nonetheless, there was this program to invest in rural areas. So the remaining 33 million would really just go to provide programmatic support. That would be support for the rural program, the new market tax credit program, which is also administered through the CDFI, as well as CDFI bond guarantee program. The budget unfortunately does not propose any funding for any of the other CDFI programs, such as the Native American CDFI Assistance Program and the Bank Enterprise Award Program. And historically, and I think it still stands that CDFIs have received strong bipartisan support. There is, I believe, the Treasury Secretary has gone on record indicating support, but nonetheless, the Opportunity Finance Network, which is the industry's largest sort of like trade industry group, continues to advocate for support for the program. And it's so while it's expected that the House Appropriations, and again, if folks just want to get very detailed, subcommittee which handles the program are expected to actually review the proposal next week on the 23rd. And again, we'll continue to advocate for CDFIs. So I'll just pause there.
Thank you, Sharon, so much. Really appreciate that and that comprehensive overview. I do think we'll probably circle back to kind of, impacts to federal cuts and especially CDFI. And also we'll be asking about like what we can do as advocates to kind of join the choir that you have through OFN and other networks and coalitions that support CDFIs across the country and here locally. And speaking of here locally, I'm excited to introduce to you Laura Dupuis, who is the Loan Fund Director with VCDC. That's Vibrant Communities Drive Change. And Laura works mostly in Virginia and West Virginia, but does have some information to share with us about VCDC's program, how it might differ from national programs, and also through their Virginia coalition, some details about lending that's happening here in Northern Virginia specifically. So, Laura, so happy to have you. Really appreciate your time and welcome to our Lunch and Learn.
Thank you. Thank you to you and Hannah and all the people listening to this, and to Sharon and Shellen. I feel very small in comparison to Shannon, especially, and Shellen's reach. However, we are sort of smaller versions of a lot of what they are doing on a much larger level, meaning they work nationally. As Jill said, our service areas, Virginia, West Virginia. We are the lending affiliate of VCDC. VCDC is an equity provider focusing primarily on investments in low-income housing tax credits and in historic tax credits. Our CDFI was created in 1996, a long time ago. Became a CDFI in 2001, and we also are a CDE that was in 2002, and we have had 2 allocations of new market tax credits. Our focus is primarily on our lending, but we really love those new market credits. They have quite an impact especially in a distressed community. I have records of loans since like 2010, despite having started in 1996. And we've made about 80 million in loans. Our housing loans is about 2/3 of our overall lending, but that 80 million includes the lending we've done with new market tax credits. And in the last 5 years, we have done about 8.5 million in housing loans. So we like Enterprise and National Trust provide a variety of loans. We have you'll find there's a lot of jargon with the CDFI fund, but one of the jargons is target markets. And we could be a business CDFI, we could be a real estate CDFI, which is what we are. Our target markets are low-income population, which is the predominant amount of our housing, and then investment areas, which is the predominant amount of our economic development lending. We have three loan programs, the affordable housing, of course, economic development, which is pretty much commercial real estate or focusing on small towns and trying to, or small neighborhoods and trying to revitalize. And then we've just launched an energy loan program trying to, and by the way, the Senate has a much nicer version of the budget than the House, but still does not support the kind of energy incentives that had been out there before, such as tax credits. Our loan programs in housing and, well, throughout our pre-development loans, like my colleagues, construction loans. We also have capital magnet funds, so we have a pool of pretty nicely revolving funds that come around for construction. And we have, and we do bridge loans with that as well. We will provide acquisition loans primarily to, in a pre-development sense of trying to help someone get their plan up for developing that space. We can convert it into what we call mini perms, not unlike what Shellen was talking about. We have a business plan that is a shorter turnaround so that we can revolve our funds, but we will go 5 years, especially in these mini perms, and sometimes have a renewal of these. So it could be a little longer. And then our terms, like my colleagues, all below market. We tie our rates to the conventional market. We do 1/2 of the market. We can, of course, go lower. We can go higher, depending on risk. As you may get the sense, CDFIs are very flexible. We also will come in, like Shellen said, early in a development. When we're doing a construction loan, sometimes every lender is like, no, no, I won't come in first. No, no, I won't come in first. No, no, you've got to take the risk. Okay, what's your equity in it? So we will come in right away, just like Shellen mentioned, and take on those higher risk types of loans. Mind you, however, we are dealing with a market that has already gone through the low-income housing tax preparation and reservation of credits. So we consider not a high risk, but a lender may. And so, I mean, a conventional lender. So we have a steady pipeline with our colleague VCDC, and we try to work with those partners who are providing affordable housing throughout the 2 states we work in. We will, as I said, be flexible. Our loan amounts are somewhere ranging from 50 to 1.5 million. We are almost always in a gap finance position. That way we can get the borrower to 100% of value because we'll go that high, depending on risk. And we also can mitigate risk for a lender if they choose to look at us that way. Some do, some don't. But on the side of what's happening in Northern Virginia, we are part of the statewide CDFI coalition. That was created quite a while ago in a very coalition-like way, not firm membership, kind of a stakeholder group that meets monthly. There's about 30 plus lenders and CDFIs that meet. There are about 19 certified CDFIs in Virginia, and that does not mean that CDFIs that are national can't operate in Virginia. It's just what we would define as Virginia CDFIs. Only about 4 of them are real estate. The bulk of the CDFIs in our state are business lenders, smaller amounts of loans, consumer possibly. We also have credit unions that are CDFIs and offer some really amazing programs because of their broader service. They would be the ones that might do home ownership. We don't. We don't do consumer lending, so that would take us out of that. And we almost always lend to a developer who is going to reach that low income population that we're trying to reach, or affect the distressed community that we want to work in and bring up. The OFN, very kindly, Opportunity Finance Network, if you're not familiar with them, they have a lot of programs, largely for members, but there's a lot of programs. They also have that large reach that Enterprise and National Housing Trust have. But they very kindly provide us with data every year that's a result of the CDFIs operating in Virginia and what they've done and in the way of lending. So we have some data, and I think Jill and Hannah are going to share that later. But very generally, the Virginia over the last probably 12 or 13 years has had about 2.7 billion in lending activity. Compared nationally, that's like 215, 216 billion. So, it's not shabby. And both the national picture and the state picture have grown in the last 5 years. So there's been more activity. There's been more of a recognition. Our coalition was created largely to increase the knowledge of people about CDFIs in the state and know what role we can play, because while it might look like we're competing with lenders, we really aren't. We cannot match a conventional lender's either size or scope or reach, but we can come in and make use of a conventional lender's tools. We can reduce costs for the developer, and so that's in large part how our CDFI works. In Northern Virginia, let me just give you a snapshot through 2022. About 5,000, a little more than 5,000 loans were made, total of $551 million. There are housing units financed by CDFIs, about 6,600, mostly a rental. There have been a few home ownerships financed by CDFIs, and I would venture those are with credit unions. But I may be wrong. And that may change given what Shellen said about the National Trust. I will echo what Shannon said about the federal government is shifting a lot of its focus, and we would be very happy to encourage advocacy of a group like yours to ensure that CDFIs continue to offer the niche and the essential financing. As I said, you go to a conventional lender, you'll get an 80% maybe loan to value. We'll go up to 100%. So that may mean you get the job done sooner than you would otherwise. New market tax credits is a completely different ballgame, but it has extraordinary effects in the market. So with that, and I don't know if I addressed everything, I will want to say that VCDC has been around for more than 35 years and has really quite a strong history of affordable housing financing and investment. So we're happy to work in Northern Virginia. You just have really high costs. I just want to say. That's all, Jill.
Yeah, no, I understand. Thank you so much. And that might lead to some of our question and facilitated discussion. So before we dive into that, I just want to level set for some of our audience who might not work in either the development or financing space about some terms that you used. And when you say you come in early, all of you mentioned that you come in early to a deal. And if you are an affordable housing developer or local government, I guess question is when should we reach out to the CDFI partner, because we know that you're often willing to have favorable terms, be flexible, and take on some more of the risk. So curious if you have suggestions about, it's probably never too early to start developing relationships with each of you, but how that typically works when you see is the right time to kind of bring a deal to you.
So I'd say we are partners, right? And we really do like talking to people early, particularly on our homeownership projects. So we lend to developers who are building homeownership opportunities. We don't do any permanent lending, but on those projects and in Northern Virginia, I think they're newer. The idea of like building for sale housing in the affordable space. So we'd like to be talking to folks early. They require a lot of subsidies. So on our Housing Alexandria project, it took like 4 or 5 other Virginia focused sources just to get that built. And what we're good at are being thought partners as you think through those pieces of the pie. So early is better. On the rental side, I haven't done a ton. I just did deal with AHC, which is a local nonprofit developer in Northern Virginia. But don't rule us out, is what I would say on the rental side. Talk to us when you have financing needs that are as early as pre-development. You're thinking about acquiring a property. You want to kind of understand how we can play a role. Amazon is a large player, but your CDFI partners can help you kind of think through those early stages.
Thank you. That's great. Any other advice about reaching out to you, and when is an appropriate time?
I mean, I'll just add, I think there was, I know there's this, common theme we've been sharing here about, projects being large, but quite frankly, projects are large across the country, right? If you want to look at DC, if you want to look at New York, you want to look at California, they're enormous. And we're still very active out in those markets. It generally just takes, as Shalon alluded to, it'll probably be multiple CDFIs coming into that transaction to make that actually happen. Or you can actually, depend on where you bring the CDFI within a transaction. Again, this would probably be something a little bit more attuned to the developers, and some of it is that as projects are taking longer, and your money might be out there for a long time. What we're seeing is people able to use this as sort of like a quote unquote liquidity play, right? Like you're right there on the finish line of that project, but you've got project 2, 3, and 4 that lined up, but all your cash is tied up in project A. So we've come in some cases that we're like, all right, you're literally at the finish line. Let's come in. We'll take that pre-dev that you might have already invested of your own capital in, so you can then take it and reinvest it into other projects at that time. So that in and of itself helps to, one, because you're saving on the cost, so it's not being carried for maybe 4 or 5 years, so only being carried for, let's say, 12, 18 months, and that just frees up your cash to be able to go out and do another project. And that might not necessarily need to be a 10, 15, whatever size deal. It might be somewhere in the 3 to 5 range or so. So yeah, I was going to say, don't, again, I'll reiterate, don't rule us out just because something is a high cost market or something is large. We're across the country and everything is big and everything is expensive.
Yeah, thank you.
I'd say that probably is always a good time to approach a CDFI, but we work in conjunction with a lot of our state agencies and state lenders, the Virginia Housing, DHCD. They often will bring us projects trying to find if we can be one of those sources because as both my colleagues said, you're going to have to layer. These projects don't let you be a one-stop shop, I don't think, for anyone. And so we're happy to come in. Something that's fully baked, we may not be able to fit our tools in, or if it's fully baked, it might be a lower risk. So there can be all kinds of ways that we would enter into a deal. And I think what we have to struggle with is whether our contribution is worth, I have a lawyer who says, is the juice worth the squeeze? Trying to see if that piece is causing enough cost savings to help you. I think the flexibility is often the place where we find that we can be the most help in addition to bringing in capital.
Great. Thank you so much for that explanation. I will just go to the checks. We have one question here, Laura, for you. And just, I don't know if you know this off the top of your head, or maybe it's something we can share out afterward, but just interested about the funders of especially the VCDF, and what percentages come from maybe government, foundations, banks, or businesses. I don't know if you know that breakdown or have
I
it.
do. I would say we do get a lot of capital in the form of equity or grants from the federal government. Um, We also have relationships with foundations where we do what are called PRIs, program-related investments, which are very low-cost loans. Often they have a geographic footprint that you have to stay in. Um, I think other people mentioned there can be a number of sources, corporations, various organizations will put money in for a specific purpose. So we have the bulk of our capital is in equity. We do have borrowed capital. We are building on that because we are worried about the reduced availability of grant funds on the federal level. But clearly, I think the philanthropic community may step up, and because we can probably affect a broader group of people than a direct grant would do for a foundation, that we may get more interest, or we have gotten more interest because partnering with us is an exponential leverager of their funds.
That's so great. Thank you so much. It's really important. We talk a lot about the importance of leverage and everybody just having, a certain stake to kind of amplify their effort. That's how we know that's how we get the work done here in layering financing, and appreciate all of your work to be the easy partner, right? We always hear about how challenging it can be across, all of our financing. So, I'd love to circle back with a couple of things that, each speaker mentioned, especially on home ownership and NHT's partnership with Housing Alexandria. You talked a little bit about that, but interested in your perspective, Shalon, of how we can replicate that in other areas of Northern Virginia, if that's even possible, and just maybe more of a description of what your investment has meant to Housing Alexandria. And you also mentioned other investors too, to kind of bring down the costs there.
Sure. So I would say generally we would like to support more homeownership projects. It's a 31 unit affordable homeownership project. It's going to be affordable into perpetuity using a deed restrictive model. And I'm not going to get into all of the terms around shared equity, but it's kind of a shared equity type model. And I'm happy to talk more about that offline. Give me a call. It's a $25 million project. It's going to be on Seminary Road in Alexandria. It has taken them quite some time to put it together. Like I said, it has 5 different sources of funding. That's just like state and local funding that's in there. And then NHC is providing a grant and a loan. So our grant dollars will stay to kind of keep the project permanently affordable. It's a little bit less than 2 million in grant dollars. And then we have a flexible loan that will be repaid after they've sold the unit. So the flexibility in that part is like we're first in, so they're using us pretty much from the pre-development phases of it, and then we'll stay in the project until they sell the units, and they'll sell the units one by one. I think what we'd say our critical role has been is that the project just, in order to do affordable homeownership in Alexandria or Northern Virginia in general, a lot of free money is needed. So a ton of subsidy dollars, and our Amazon pilot money just kind of became another one of those free pots of money. So to replicate that, you do need to find a lot of free money. So they worked with Virginia Housing, Alexandria Housing Opportunity Fund, the Housing Trust, the commissioners, High E. So those are like the 5 sources of like free funding that stays in the project. These sources typically require some sort of affordability in either for a 30-year period or in perpetuity. So it gives the county, the state, it kind of gives them in return affordable homeownership options that won't leave with the first buyer. So when the first buyer leaves, the second person who buys it also then has to keep it affordable. So replicating that model, you'd be thinking, what are my subsidy sources? And then what is my EMI level that I'm trying to hit? So am I trying to sell to people at 80%, 120, 60, 50? And that kind of determines how much subsidy I need, how much debt the project can take on. And in a typical rental, you would then approach a lender and you can come to NHC to say, I'm looking to build or rehab a property that's going to be affordable home ownership. Here's the debt the project could support because this is what the homeowner can then get a mortgage for. We'd be your lender that would lend that funding to you. You'd repay us just based on that. And the subsidy that you get, the sources that you'd amass from various places, would then become the long-term subsidy in the project. So if anyone wants to talk more or have any ideas around projects they're working on, we're always happy to brainstorm with you to share with you what Housing Alexandria has done on this project, the sources they've used, and then also just generally other sources. I'm actually right now at an event where I'm learning more about shared equity and what's available on the permanent side for co-ops and CLT type lending. So happy to share the knowledge I'm gaining today as well.
That's great. Thank you so much for that overview. Really appreciate it because I do think it's a really amazing opportunity and model, hopefully. So Sharon, just a question from the chat for you. Just if you're aware of any private foundations, and I know Enterprise has led in this space as well, but specifically lending to affordable housing sectors that have been impacted by climate and natural disasters and mitigating climate risks for affordable housing. I don't know if you, I know Enterprise has been part of that, but if you know of others as well, or if you want to speak to Enterprise's commitment to that work on
Yes,
things.
yeah, and that to your point, Jill, that's a space that we've played as a fund manager. That means we either through a local state agency amassing funds and administering the funds on behalf of those various organizations. So we've certainly played, and we're actively. I can't name them all off the top of my head, but we certainly in almost every major. I would say a lot of the natural major disasters that we've had, we've certainly played that role, and that we're looking to do in California. We've certainly done in Louisiana and other spaces where we do help to be the fund managers as well as, and usually requires capital raising from various foundations. Fortunately, I can't say the foundations off the top of my head in terms of which ones, but the short answer to that question is yes, there are foundations that do provide capital to support renovation for or rehabilitation of projects or homes that have been impacted by climate change and natural disaster.
That's great. Thank you so much for that. Laura, I want to just circle back to you a little bit. I know we can and we probably should and maybe will do an entire lunch and learn session on the new markets tax credit. But can you speak a little bit to VCDFs, what that is and how you've been able to access that and in turn how that's impacted your work in lending? Because I think there might be just some additional education, basic education that would be helpful here.
New market tax credits.
Mhm.
Okay. The premise of new market credits is to create jobs, bring a level playing field into areas that are low economic bases. It is not necessarily a housing program, although there can be housing in it with some uh, restrictions. They're pretty light restrictions. It is largely an economic development engine. And the way you access them is by becoming what's called a community development entity, a CDE. And that entity can apply for new market tax credits that have been on an annual cycle round. They might skip a year and then they'll do a double year, and then the appropriations is up for expiration the end of this year. And there is the Senate bill does have it permanently appropriated. So that would be great if people can recognize the value of those. I'd say the value is largely it's a high cost program, but it will bring several $1 million that you wouldn't have already brought in to the project. The primary way I've done it is with what's called a leverage structure, which requires a great deal of capital raised by the sponsor that then is matched on a proportional basis with tax credits that have a pretty significant equity result, depending on the pricing, of course. So it's another form of equity investment. It's not for the faint of heart, but it really can make a big difference in a particularly in an area that can't otherwise mount some of the needs. Community facilities really benefit. The high opioid crisis in the rural parts of our country are trying to access these programs because so much of it is not serving people with earned income for a while. So there's a lot of need to get these community facilities up. You also see new market tax credits used for hotels and various things. So we tend to stress projects that would be very hard to do otherwise or not able to be done at all except with new markets. And I think most CDEs approach it that way. But the outcome has to be jobs, the outcome has to be community benefits, and the community benefits are for low income people. So it's a high distress targeting investment tool.
Excellent. Thank
I
you.
don't know if that it's a course in and of itself. I've done it for years and I still kind of stop about halfway through an explanation. So
Well, I do think it is complicated, and I think it is complicated maybe for, affordable housing development in addition, but, always, I think we're always looking and relooking at all the tools in the toolbox because we know that there are shrinking
it
resources
really
there.
can make a difference.
Yeah.
But it is a struggle to get. The credits are hard to get. The investors, I mean, it's a tough market and it requires a lot of attention. And um, I can't speak highly enough about it. And I also have to tell people that it's hard.
And new markets are now being used for affordable home ownership. So when you're having that
Yes.
discussion, it might be nice to also include how they're using it in that way as well, which I think is fascinating.
Have you had experience with that?
We are a CDE, but we haven't been successful yet in getting an allocation from the CDFI fund to do that. But I can point you in the right direction of other partners who have. Habitat DC Nova, which also operates in Northern Virginia, have been using the credits. We worked on a project with them in Deanwood in DC, where that equity from new markets is part of the capital stack.
Yeah.
Excellent. Thank you.
Yeah.
Yeah.
Yeah, I was going to say Enterprise has done I believe one pro. It's not something we do frequently in terms of leveraging the market tax credits for home ownership, but they can be paired with LIHTC. Currently working on a project now, which I think really is literally running the gamut of all the tax credits, including low income housing tax credit, new market tax credit, investor tax credits, all of it into one single project. So it can be layered.
Thank you. That's great. Just a few more questions as we wrap up. And I guess, just looking at the Northern Virginia market and if you see that as a, strong market for CDFI lending, if you feel like CDFIs, and I know you just represent your own organizations, but it does seem like, frequently you are participating in a lot of our LIHTC deals, which is how we're seeing most of our affordable housing development take place. And just any thoughts in general about the Nova market and ways in which we can better harness the power of like our CDFIs. I will also acknowledge that we do have strong statewide partners at Virginia Housing who do fund pre-development activities, and that could be part of it through. I know Ayan mentioned in the chat the Planning District Commission funding that also supported Housing Alexandria's project, which was Seminary Road. I think it's now Cardinal Path, so they just maybe renamed. But yeah, so any thoughts just about Northern Virginia in general?
So I would say quickly I know we have a lot of like the state and local folks on the line, the local folks. It's talking to us about what partnerships look like. So I think we're good at also leveraging other people's dollars. So you may have a smaller pod that a CDFI can use and partner with you on to provide, more funding within your jurisdiction, particularly on home ownership. I know that there's some, there are policies that we can talk about fixing and making easier to make accessing funds easier and building easier. So I think those are also good conversations for us to have.
That's great. Okay. Anybody else?
I would say in general, I think folks are generally look at the Northern Virginia market as being a pretty I think like robust market. One that folks are, at least I would say we're certainly interested in. I think there are lots of great partners, both at the local and state level that I do think help to make projects move a little smoothly. We'll just say, some jurisdictions are a little easier than others, and I think it's the general consensus is that Virginia tends to be one of those, more proactive and easier to um, uh, uh, maneuver through jurisdictions in terms of actually, getting affordable housing projects done.
Yeah, and I would say we've not made many loans in Northern Virginia, but VCDC has done LIHTC. If you want to move down a little further into Culpeper and places like that, we have done loans there. And I would echo that the Northern Virginia localities have a pretty enlightened view of how to direct funds to support affordable housing, probably more so than any place else in the state.
Great. Thank you for that. I do recognize that having worked statewide and, how fortunate we are here in Northern Virginia, but also recognize we do have goals that have been kind of illustrated and commented. Thank you, Jerry, in the chat for sharing our challenges in Fairfax County and Northern Virginia with production. So I guess on that note, I'll just wrap it up, not to end on a negative note. We're trying to keep things positive, but what is keeping you up at night? I guess the three of you in our current housing ecosystem. And what do what are your concerns for either your organization or our industry? And really, how can everybody here on this call help with advocacy efforts to kind of, address those concerns? I saw you come off mute, Sharon, so maybe I'll. Do you have any thoughts about
Sure, sure. I was going to say, yeah, I saw that question. I was like, what could I answer? Quite frankly, I think it probably the same that a lot of folks here are, this uncertainty that's being created at the federal level. As what we do is hard. It was hard before. And it's just made it even more difficult. We all remain committed to doing what we do, and we'll keep doing it. But it is tough. And so it's, everything is just trying to figure out how do you mitigate for it, and and yeah, just keep going. So yeah.
I agree with that.
Yeah.
I won't say it
Definitely.
keeps me up at night. There will be CDFIs now and in the future, but our funding sources from the government will likely be less and not quite, no true incentives for the people we're trying to serve.
Yeah.
Yeah, I mean, I'm on the capital raising and the deployment side of things, so like all over the place. So there are like many different things that are keeping me up, but just the stability of our industry. Like Laura said, we are going to be around. We're scrappy, right? We know why we exist and we want to continue to do this work. It's mission for us and not money. So we'll do the best we can, but everything's making that harder. So you're constantly thinking about mitigating all kinds of things. And what if that happens? What do we do then? And do we really need this money or that money? And, all the different things that keeps you going. And, our affordable housing developers are struggling through some of this too. So we're holding hands and kind of commiserating together of like, it will be okay. We will figure it out. We've existed before this and we will after this. I think advocacy generally just looks like understanding the important roles that players like us play in keeping an industry alive and keeping affordable housing and small businesses going in your communities. And once you're able to do that, you yourself will get passionate about advocating for just our funding sources to not be taken away, but for us to continue to do the work that we are doing so that each of us could have a place to live, right? And each of us could have access to resources that makes our lives easier because that's what's being threatened right now.
So well said. Such a great way to kind of end. I want to thank you so much to our amazing speakers sharing a wealth of knowledge. Obviously, there's so much more to learn on this topic, but I hope the takeaway that you all have is the importance of this component of our affordable housing finance system, the flexibility, that it provides a lot of our projects and reaching our goals. And just want to thank Laura, Sharon, and Shalon for joining us today. I hope you will reach out to them. We will send their contact information. So if you have additional follow-up questions, you can ask them. Really appreciate you being here. I hope you will join us next month for our July Lunch and Learn, which will be on health and housing. And so I think that RSVP is out, but really hope that you'll sign up to join us. And then in August, we'll have our virtual bus tour. So we look forward to seeing you then. Thank you all. Have a great day.
Thank you.
Thanks.
Bye,
Bye-bye.
everyone.